This video is for educational purposes only. This is analysis, not financial advice. Warren Buffett created a single metric in 2001 that he called probably the best measure of where valuations stand at any given moment. And right now that indicator is flashing the most extreme warning in history. The Buffett Indicator, which compares total stock market value to the size of the economy, just hit 220.2% as of November 7th, 2025. To understand how dangerous that number is, you need to know what Warren Buffett himself said about it. When this ratio approaches 200%, you are playing with fire. We're at 220.2%. But here's what makes this truly unprecedented. The indicator has only exceeded 200% 3 times before in 95 years of data. Once in late 2020 when it peaked at 216% during the COVID money printing frenzy, followed immediately by the 2022 bear market where stocks fell 25%. Once in early 2021 during the same bubble, and once just now in November 2025, hitting 220.2%. Every other time in history going back to 1930, this ratio has been lower. The dot-com bubble peaked at 150% before the NASDAQ crashed 78% and took 15 years to recover. The 1929 crash happened when the ratio was around 100%. We are now in territory that suggests either the economy needs to grow dramatically to justify these stock prices, or stock prices need to fall dramatically to match economic reality. History tells us which one happened. Let me explain exactly what this indicator measures because understanding the mechanics reveals why it's so powerful. The Buffett Indicator takes the total market capitalization of all publicly traded U.S. stocks, currently $65.47 trillion, and divides it by the gross domestic product, which is $30.15 trillion annually as of the second quarter 2025. That gives you 217%. Different data sources show slight variations between 217 and 220%, depending on which stock index they use and update timing, but they all tell the same story. Stocks are worth more than double the entire output of the American economy. Think about what that means. The paper value of corporate America is twice as large as everything the country produces in goods and services in an entire year. That's not a normal relationship. For most of the 20th century, this ratio stayed between 50 and 100%. When it hit 150% in 2000, Buffett wrote an article warning investors they were in dangerous territory. The market proceeded to crash 78% over the next 2 years. The mathematical reality behind this indicator is simple but brutal. Stock prices ultimately derive from corporate earnings. Corporate earnings ultimately derive from economic activity. If stocks grow much faster than the economy for an extended period, one of two things must happen to bring them back into balance. Either economic growth accelerates dramatically to catch up to stock prices, or stock prices fall dramatically to match economic growth. There's no third option where stocks stay permanently detached from economic fundamentals. The ratio always reverts to more normal levels. The only question is how and when. Historically, when the Buffett Indicator has been this high, future 10-year returns from stocks have been terrible. Research analyzing data back to 1970 shows that when this ratio exceeds 200%, investors should expect returns of negative 0.8% annually over the following 8 years. Not 1%, not even breaking even. Negative return. You would actually lose money in nominal terms before accounting for inflation, which makes the real loss even worse. Here's where this gets really disturbing because it's not just the Buffett Indicator screaming danger. The Shiller CAPE Ratio, another legendary valuation metric, is also flashing extreme warning. As of November 12, 2025, the Shiller CAPE stands at 40.4. This metric was invented by Nobel Prize-winning economist Robert Shiller, who used it to correctly predict both the 2000 dot-com crash and the 2008 financial crisis. The CAPE ratio looks at current stock prices divided by average inflation-adjusted earnings over the past 10 years. By using a 10-year average, it smooths out the impact of economic cycles and temporary profit spikes or crashes, giving you a clearer picture of underlying valuation. The historical average KP ratio since 1880 is 16.9. We're currently at 39.67, more than double the long-term average. The CAPE ratio has only been higher once in 145 years of data, and that was December 1999 when it hit 44.2 right before the dot-com bubble burst. After After a strong performance in October 2025, the CAPE climbed well above 40. Robert Shiller himself just issued a stark warning to investors. Based on current CAPE levels, he expects the S&P 500 to return only 1.5% annually over the next 10 years. When you subtract inflation, Shiller is actually forecasting that investors will lose money in real terms over the next decade. That's not fear-mongering, that's mathematical projection based on a model with over a century of validation. The comparison to 1999 is chilling because everyone remembers how that ended. In March 2000, the NASDAQ peaked after a spectacular run where tech stocks had quintupled in 5 years. Then reality set in. The NASDAQ proceeded to lose 78% of its value from peak to trough. Amazon, which survived and thrived, still fell 95% before bottoming. Cisco Systems, the darling of that era, peaked at $82 in March 2000. Today, 25 years later, after inflation, after stock splits, after 2 decades of growth, Cisco has never recovered to that peak. Investors who bought at the top in 2000 are still underwater a quarter century later. That's what happens when you pay bubble prices even for genuinely great companies. The technology was revolutionary. The internet did change everything, but the stock prices were insane, and paying those prices destroyed wealth for a generation. The margin debt situation makes this even more precarious because it shows how much borrowed money is propping up current stock prices. Margin debt, the amount investors borrow from their brokers to buy stock, hit $1.13 trillion in September 2025, according to FINRA data. That's an all-time record in absolute dollars. More importantly, margin debt has spiked 39% since April 2025, the biggest 5-month increase since October 2021. And what happened after October 2021? The market peaked in November and then fell 25% over the following year. Margin debt surges indicate excessive speculation and risk-taking. When everyone is borrowing money to buy stocks because prices only go up, that's usually the exact moment before prices start going down. The pattern has held for decades. Margin debt peaks, then stocks peak shortly after, then both collapse together as forced selling from margin calls accelerates the decline. Here's what most people don't understand about margin debt and why it's so dangerous. When you buy stocks with borrowed money, you're making a leverage bet. If stocks go up, you make amplified return. But if stocks go down, your losses are also amplified. And there's a built-in forced selling mechanism called a margin call. Brokers require you to maintain a minimum equity level in your account. If your stocks fall and your equity drops below that threshold, the broker demands you immediately add more cash or security. If you can't, they liquidate your positions without asking permission, often at the worst possible prices during a panic. This creates a vicious cycle. Stocks fall, which triggers margin calls, which forces selling, which pushes stocks lower, which triggers more margin calls. In October 1987, this dynamic contributed to the single largest one-day stock market crash in history, a 22.6% drop in the Dow Jones Industrial Average in one day. Back then, margin debt was measured in billions. Today, it's measured in trillions. The scale of potential forced selling is exponentially larger. The concentration risk in today's market amplifies all of these dangers. The so-called Magnificent Seven stocks, Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla, now represent approximately 30% of the entire S&P 500's market capitalization. Nvidia alone accounts for over 8% of the index. When 10 companies out of 500 comprise nearly a third of total market value, you don't have a diversified market, you have a handful of stocks carrying everything else. And those stocks trade at valuations that assume flawless execution, unlimited growth, zero competition, and perfect economic conditions forever. Nvidia trades at a PE ratio that prices in continued exponential growth in AI chip demand. But what happens when cloud providers realize they've overbought capacity? What happens when competition from AMD, Intel, and custom chips from hyperscalers erodes Nvidia's pricing power? What happens when AI spending slows because companies aren't seeing return on investment? These aren't hypothetical scenarios. They're already happening. Microsoft just reported cloud growth decelerating despite massive AI investment. That's the first crack in the narrative. The AI bubble parallels the dot-com bubble in ways that should terrify anyone who lived through that era. In 1999, everyone believed the internet would revolutionize business, and they were right. But being right about the technology didn't mean every internet stock at any price was a good investment. The business models were unproven. Revenue growth was real, but profits were imaginary. Companies were valued on eyeballs and clicks rather than cash flow. When the music stopped, valuations collapsed. Today, AI will absolutely transform industries, just like the internet did. But that doesn't mean current AI stock prices make sense. Many AI companies have minimal revenue and zero profit. They're burning billions on the promise of future dominance. Cloud providers are spending hundreds of billions on AI infrastructure before proving customers will pay enough to generate positive return. This is the exact same pattern. Revolutionary technology, real transformation, insane valuation. The first two things being true doesn't validate the third. Let's address the counter-arguments, because intellectual honesty requires acknowledging the other side. The main argument for why valuations might stay high is that interest rates, while higher than during COVID, are still relatively low by historical standards. When interest rates are low, future cash flows are worth more in present value terms, justifying higher stock price. There's truth to this. The problem is that inflation is also elevated. Real interest rates minus inflation are what actually matter for valuation. When you factor in inflation, real rates aren't particularly low anymore. The 10-year Treasury yields 4.5%, but inflation is running at about 3%. That 1.5% real yield is close to historical averages. There's no justification for twice historical valuations based on interest rates that are near historical norms in real terms. The other argument is that technology, particularly AI, will drive unprecedented productivity gains that justify current valuation. Maybe. But we've heard this before. The internet was supposed to drive massive productivity gain. It did eventually, but not enough to justify 2000 valuation. The market still crashed and took 15 years to recover. Being right about the technology and wrong about the valuation is an expensive mistake. Another counter-argument is that profit margins have structurally increased. So comparing current PE ratios to historical averages is misleading. Companies today are more efficient, have more intangible assets, and generate higher margins than industrial-era companies. This is partly true. Profit margins are higher than 50 years ago. The CAPE ratio accounts for this by using 10 years of earnings, which captures the current higher margin era. And even adjusting for higher margins, CAPE of 40 versus a long-term average of 17 suggests substantial overvaluation. If you argue margins will stay elevated forever, you're arguing this time is different, which is the most expensive 5 words in investing history. The timing question is critical because being right about valuation, but early on, timing can still lose you money. The Buffett Indicator hit 190% in late 2021, suggesting overvaluation. The market then rose another 25% before peaking. Anyone who sold in late 2021 missed those gains, although they avoided the subsequent 25% decline. The lesson isn't that you should ignore valuations. It's that valuations are terrible timing tools. They tell you what, not when. Stocks are expensive, future returns will be low or negative, but the exact top is impossible to predict. The solution isn't to try timing the top. The solution is to understand that when valuations are extreme, your margin of safety is gone, and the risk-reward equation is terrible. You might make another 10 to 20% if the bubble inflates further, but you risk losing 50% when it pops. What should investors actually do with this information? These are educational frameworks for thinking about valuations, not personalized recommendations. Everyone's situation is different. First, understand that broad market index funds become dangerous when valuations are this extreme. An S&P 500 index fund is concentration in mega cap tech masquerading as diversification. 30% of the index is 7 stocks, and all 7 trade at valuations that assume perfection. You're taking mega cap tech risk whether you realize it or not. Real diversification requires actually diversifying, not just owning an index dominated by the same handful of names. Second, increase cash holdings even though cash feels uncomfortable. Cash yields around 4.5 to 5% in money market funds or short-term treasury bills right now. That's not zero like it was during COVID. Earning 5% risk-free while waiting for better valuations is actually a viable strategy. If stocks fall 40% over the next few years and you're in cash earning 5% annually, you're dramatically better off than being fully invested. Cash is optionality. It lets you buy when others are forced to sell. Third, Focus on fundamentals, not narrative. Companies with genuine cash flow, reasonable debt levels, proven business models, and valuations that make sense will hold up better than concept stocks trading on hype. The AI winners are unknowable today, just like the internet winners were unknowable in 2000. Amazon was one of hundreds of e-commerce companies. Google was one of dozens of search engines. Most didn't survive. Trying to pick the AI winners at peak valuations is the same gamble. Better to wait for reality to separate real businesses from failed experiments, then buy the survivors at reasonable prices. Fourth, prepare psychologically for what comes next. When valuations revert, it won't be a slow grind. It will be fast, violent, and terrifying. You'll see your account value drop 30, 40, 50%. The media will panic, friends will panic. Your instinct will be to sell to stop the pain. That's when you need discipline. If you've reduced concentration risk, diversified internationally, held cash, you'll be in a position to buy, not sell. The greatest wealth transfer in history happened from 2008 to 2009 when Warren Buffett deployed billions into crashed markets while everyone else capitulated. The same opportunity will come again. Being positioned to take advantage requires having capital and courage when everyone else has neither.